Hello, hello, welcome back. So, a couple of months ago or so, I talked about Robinhood. Back then, I urged some caution to investors that investing in Robinhood right now may not be a good idea because it is massively overpriced. There is nothing proprietary about it, it's just another broker. And it was really about the trendiness of the thing. It was basically a trendy period where pretty much everybody was buying it, and this is why it was going higher. Now, Robinhood helped us, investors, pay less for our commissions because a lot of brokers actually had to follow this zero fee model for when you are actually trading. So you are not paying for a commission anymore in many brokers. It's sort of like the standard right now after Robinhood. However, in terms of buying the stock, there is a little bit of a problem here, and you will see that reflected in the stock price, which is down 88% right now. And I believe they had an earnings miss as well. If we take a look at the news here, you will see that Robinhood shares were down at some point 12% pre-market. Looks like it's a little bit better now, but it's still down, and the company reported weaker than expected results. You'll see here that they lost 392 million versus the year ago figure of 1.4 billion. So it's actually it's actually the company is still losing quite some money here, 392 million. We're going to take a little bit of a look at the financials and what is going on here. Now the P ratio is negative because the company is net income negative. There's some free cash flow that we will see how it gets generated. And the outstanding shares are pretty much the same thing. Little has changed. Now, you will see the 5-year net income growth going down. Obviously, we don't have 5 years of data. This is a new IPO. And the revenue growth has been increasing as you would expect. Free cash flow growth going down too. And the total equity growth going up for the company. We'll see that in a little bit more detail, what's happening there. Now look at these margins here and return on equity and all that. This is all negative. I mean, the company is not really profitable yet. And so what we kind of want to see is what they're doing in terms of their income statement, just to discover how this gets moving. Now, 277 to 1.8, so there is a steep increase in revenue. That's a good thing. But what about net income? So they used to be positive for a while, and now they're turning back to full negativity here in terms of their net income, and that's not great to see. 2021, they lost 3.6 billion. Massive amount that is very concerning. Balance sheet. Now, the total equity of the company keeps increasing a little bit over here, as you'll see. More total assets coming from additional paid-in capital, it looks here, from investors pretty much, so selling some shares. Okay, let's just see the cash flow statement or what else is happening. So we're seeing that the company is not really funding themselves from profit, is the thing. Obviously, they are losing money. And you will see here that the net cash provided by operating activities is negative, as you would expect. And net cash used for investing activities is also negative because the company is investing in some things, some capital expenditures as well, and issuing some shares. They are issuing some shares here. Cash at the end of the period is sitting at 10 billion, and the free cash flow is getting into negative territory. I want to just take a little bit of a quick glance at the outstanding shares here just to see how they are doing. Yeah, so they are going down. It looks like they have sold some treasury shares or so in order to be able to fund themselves from that, because they don't seem to have issued more here. Okay, so we are seeing that the company is not really doing that well here. And if we take a look at our stock evaluation tool, we will see that, they have been achieving some pretty explosive growth that is kind of to be expected. Yet, look at this net income growth. This has been terrible. It has been going down and minus 3.686. That's steep losses here. The net income margin is, of course, super negative here. And what can you even do with this one? Negative cash flow, of course, as well. What can you even do? Even if you try to examine company's profitability here, just by using the revenue, you don't have much in terms of margins. Like the margins have been, for the most part, negative. We can try to do something, and let's just say that we accept that the company will achieve 20, 30, or 40% of growth in the next 5 years. Again, this is a high growth company. It may achieve these values, especially 20%. But I'm going to be taking confident projections just to see what kind of values we are getting out of those. Now, our net income margins are always negative because, the company is not making money. But I'm gonna be using something that's kind of sensible for a company that's just starting to make money. Let's just say 3, 4, actually 3, 5, and 7%. Again, this is super confident. It's the company is far from achieving that, but I want to do it for the sake of the exercise. Free cash flow margin, I'm gonna use something that is rather typical for companies. I'm gonna go like 80, 90, 100. And an annual return of 13% is what I at least want to be making from any single stock that I own. Calculate here, and you will see that even our current price is far above what we'd like it to be, especially when we are taking into consideration that the company is not making any money and we are actually projecting results that do not even seem near happening yet. And so the company keeps losing money. I don't know when or if they will ever reach profitability, maybe in a few years. But the problem is I don't have anything to buy them for right now. And so if I'm buying, I'm basically sort of like buying a ticket to a lottery, and I'm waiting for it to potentially reverse in the future, but I would already have overpaid tremendously today. And so this is why I don't like buying companies that are not making money unless they are like super cheap, which this one is not. Even after falling 88, whatever was it, 88%, it's still expensive for what it is. And so this is why I would avoid. And even as it has dropped much more than my last video, I still would avoid the company, again, because of the issues that I mentioned. And a price to sales ratio, like even if you want to go with this one just to use it for evaluating a non-profitable company, it's still a little bit elevated. Again, if you're buying a company that is not making money, you should make sure to at least buy it at a bargain price, at a very cheap price. Otherwise, you are adding yourself a ton more risk for no real reason. And so this one I would avoid for now. And let me know what you think. Are you a buyer of Robinhood stock? What do you think about it? And remember to leave a like, because that really helps, and subscribe if you're not a subscriber already. I'll see you in the next one. Bye bye.